Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hi folks, Eric Susi here. Today is Friday, December 17th, 2021. It's our last episode, number 18, episode 18 of 2021. So welcome to Vantage Point with True North Wealth Partners. Like I said, I'm Eric. My partner, Andy Smith, unfortunately could not make it today. So he gives his wishes. Something came up, so he had to bug out. But he says hello to all of you. So with that, there's a lot to cover today. And it's going to be unique because I don't have my partner to bounce things off of. So it'll be a little technical, a lot of charts and visuals, but we'll get right into it because we do have a lot. So today, if you recall back on episode 15, it was quadruple witching day. Can't even say the word quadruple. So quad witching day is today. And so again, what that means, there's four basically sets of financial instruments that are going to be expiring the same day, pretty much the last hour of trading. So from 3 to 4 o'clock, like I mentioned before. So just as a recap, the four assets that do expire today are the stock options, single stock futures, stock index futures, and then the stock index options. So those four, particularly, all four will be expiring today. And again, it happens 4 times a year on the third Friday of the quarter. So in the March, June, September, and now it's December. So I just wanted to point that out. You'll see elevated volatility today, and that's just a little food fact for that. So with that, let's bump right into the Cobra Tracker. As you can see, it's still, it's going to be around, it looks like, a few more months, especially heading into winter time. But interesting, you can see the reported tests for the flu. So that's the tests are there, but the reported cases are nowhere to be seen. So just interesting how they cases have vanished and everything's labeled COVID for whatever reason. So that's that. You can see on the COVID tracker. Moving on, as you can see, to the recovery tracker that First Trust puts out. They do a great job. And just a few things I do want to point out. One is going to be the ASA staffing index. So the staffing index is really the part-time folks. So with the job openings, over 11 million jobs that are available. And with the quit rate, people quitting their jobs is the highest, and since they've been tracking it. So people are quitting, going to other positions, but they're not really necessarily drawing in new people into the workforce. So they're going to the staffer, the professional agencies to fill jobs. So you can see here in the ASA staffing index, it's spiked up nicely here, and particularly since August, September onward. It did turn down just recently here in November. But that's the holiday season per se. But it is interesting. It is elevated over 2019 and 2020. And then the box office, movies, some Spider-Man's coming out. Nathan's excited, my producer here, to check it out. So it's all good. But you can see the box office receipts have bounced around all year long. But better than 2020, obviously, not quite as high as 2019. But we'll see if that continues the trajectory and bouncing up over the holidays. So just a few things, it's still ebb and flow. Certain months are good. Other months, with the new variation that has come out, Omicron, what have you, for the COVID. So you're going to have ebb and flows throughout. So hopefully we'll stop talking about this at some point in time. But for now, that's where we're at. Okay, folks, let's get into some important, relevant topics of this past week or so. So first, a lot of information from FedPal has spoken. November CPI numbers were released, also the PPI numbers. So November CPI, Consumer Price Index numbers came out. And again, this is from First Trust, one of our resources that we use, strategic partners. Year over year, 6.8%. So 6.8% year over year, November to November. So obviously that's the highest in decades there, going back, I think, since the early 80s. So just keep that in mind. Yes, we're feeling it at the grocery store and amongst other places, gas pump, etc. November PPI is called the Producer Price Index, PPI, for businesses, organizations, input costs, things of that nature. That is up final demand 9.6% year over year. So again, it's costing input costs for companies, whether it's resins, oil, plastics, you name it. Things are higher. Processed goods are up 26%, 26.5 year over year. Unprocessed goods are up 52.5%. Services are up 8.1. Goods are up 14.9. So but overall, the final demand number, when you blend it out, it's 9.6. Again, it's the money supply, the M2, which is a money supply, is now 39% above the pre-COVID levels. So over the last 2 years, it's 39% higher. That just means there's a lot of money in the system. So that's one of the factors that has led to a higher overall inflation. So, interesting how Powell then comes out and speaks this week about, yes, okay, he admits the transitory that he was stating all year long that we have not on all of our podcasts all year long since January, that is not transitory. He's now given up, thrown in the white flag, that he's going to drop the word transitory. Well, it's a little too late, because actually this is the peak. So November, December are the peak months for the inflation. So a lot of the inflationary parts will be rolling over, not going straight down, but they're going to be ebb and flow. So certain parts will still be around for inflationary. We still have the shipments out in California, amongst others. So that has decreased, but then you have more parked out abroad in the ocean, still waiting to come in. So, give that another 6 months for that to fully roll through and take effect. So again, inflation, we believe, and this is also coming from not just First Trust, but Hedgeye, and Argus, other ones that we use as far as our strategic partners. So it is what it is for now, but we hope that things will be rolling over. And with that, Social Security on this chart, which you'll see as well, Social Security, the COLA. As a reminder, I know Andy and I mentioned this to you earlier, the COLA that's going to be effective in January here in just a couple of weeks for your benefits, going to be increased 5.9%. So that's a 5.9% increase. Again, that's all pretty much tied to consumer price index or inflation. So that is the highest actually since 1983, going all the way back to 1983 when the COLA back then was 7.4. So having a visual graph, I think you'll find that interesting. So 1983 was 7.4. Next highest is 2022 COLA, which is 5.9. And then the next highest after that is 5.8, which is back in 2009, financial crisis, et cetera. One last thing here in regards to the Fed, Powell, and just overall federal dot plots and what the Federal Reserve and what they want to do. You can see on this slide here, they still want to target a 2.5% long run, meaning over the next couple of years, 2022, 3 and 4, to they want to raise rates. Before he spoke this past week, it was more like a 1, maybe 2. Now the markets think it's going to be 3 federal interest rate increases. We'll see about that. So it's going to be challenging. So multiple, LPL, Dayhagen, First Trust, Brian Westbury, and then Hedgeye. Multiple things people are saying could be 1, it could be 3, or maybe 2. So no one really knows, but 3 is going to be a stretch. And even Andy and I don't believe it will be 3. Because the economy, markets, inflation, GDP will be slowing. So what the Federal Reserve, in regards to the tapering, so the tapering, they're going to increase that, double it from 15 billion less per month to 30 billion less per month. So that brings up the forwardness of getting out of the bond buying business, and by the end of March. So by the end of March 2022, the $120 billion a month the Fed has been spending to artificially keep rates low, stock market propped up, The training wheels are finally coming off. So this is what Andy and I have been waiting for. So for folks who we use asset allocations, diversified modern portfolio theory, it means you're diversified across multiple asset classes, 15 or so at least. So with that being said, a traditional diversified balanced asset class has not performed as well in a artificially propped up economy. So by the Fed, alpha should return, and we're looking forward to a better 2022 as far as performance-wise, things of that nature. And again, what will help is the Fed getting out of the way, stop supplying money. The Build Back Better, that looks like it's dead for now. That's great. So no 2/4 trillion will be added. So that's good. There's just too much, like I mentioned earlier, 39% more M2 money supply in the system. So as you see the federal target rate there, and these are the Fed dot plots, all the board members meeting, you can see 2022. You can see the blue dots there. Each one represents a voting. So at least, a quarter point, possibly up to 3 rate increases. We'll see about that. So we're taking the under officially at this point in the game. So with that, let's transition on, into a few other charts. Commodities, you can see here, commodities, the lumber jumps out at me right away, and you can see this spiked up this year, came back down the last few months over summer, and then spiked up just again recently here, the past 2 months for lumber in particular. Copper sort of level, corn has increased. It's around $5.90 a bushel right now. Oil has come down somewhat in the $70 range from the 80s. So again, commodities, we had that play on. And then, like I said, things will be still going higher. Other things will be going lower. Wage growth, another part, that led to inflation is wage growth. So you have a 5.9% wage growth increase. So again, when employers have to pay more, they can't take that back. So that wage increase, that cost of input to that business is then ultimately passed on to the consumer. So we're feeling it all across the board. So wage growth is another one. Labor force participation rate, just another little quick blimp. So it's 61.8. Okay. We want to see that higher. That's the best, most efficient way to get out, to shrink up that 11 million job openings, to get those people back to work. So the peak, as you can see, is 67.3. The average is 62.9, and we're at 61.8. So progress, but it's slow progress. It's it's going to take longer to get things going there. Talked about GDP quarterly. So GDP. Estimates from the Nowcast and Federal Reserve Bank of Atlanta came out this couple of days ago. 7.2 is fourth quarter GDP estimates. So that's all over the place, anywhere from 5 to 7%, what we've been seeing. So we hope it bounces back and stays elevated. I think that's a little robust, but we'll see. That's just the initial look there. The latest look, I should say, is 7.2. Interest rates, we've seen this before, folks. So you can see the 10-year and the 2-year. The 2-year has spiked up dramatically, and it front runs an increasing Fed increasing interest rates. So you can see that in the short end of the yield curve, that's the 2-year, has spiked up. So it used to be 0.22, 0.25. Now it's 0.69. So that's a December 15th. And then the 10-year, it was earlier, 175, came back down, 130 range, and went back up and down. So it's 1.47 was the last data print. So the yield curve, it's going to be interesting. So the bonds, folks, really haven't seen much. It's going to be a challenging year for bonds, definitely into 2022, as the bonds rotate, as rates do rise, as anticipated by the Fed. So that's to be expected. Market pullbacks, just as volatility is there. So you can see the VIX volatility index. Again, this is what the traders think the volatility, the spike in the market for the next 30 days may be. And the latest print, December 15th, is 19.3. I saw it over 20 today. So it's over a little over 20. The average is 18.1. So you're going to have the ebb and flows with spikes. And next year, you will see more of that. So And I'll with this last chart here, stock market pullbacks at 5%. So officially, we only had one 5% pullback this year that registered. So it's based on closing prices. So the S&P had one 5% pullback this year thus far. And again, the average is 4.6 times per year. The S&P 500 has at least a 5% pullback. So next year, Andy and I were talking, we expect more above the 4.6. So 5 or so times, maybe even 6, we may see as far as more volatility. So, and we haven't had a 10% correction. So we haven't had a 10% correction in quite some time. So that leads us into more of a forecast. What do we see for next year? There's a lot out there, and a lot of folks have provided guidance from all of our strategic partners. Just First Trust, Brian Westbury. So a lot of things are out there. He's anticipating, the S&P to be 5,250, 5,250 for the S&P by the end of 2022. So it's 10, 11%, increase. We have other firms. LPL is more at the 5,000 range. So 5,000 to 5,100 range is what LPL is stating by the end of 2022. So again, they're all over the place. GDP this year came in upper 5s, or will come in, in the upper 5 range next year. A lot of different people. LPL is in the 4 to 4.5% range for GDP growth. So slowing GDP, still elevated, meaning still higher than normal, which is great. Going back to Westbury at First Trust, they're saying the Fed anticipates a GDP of 4%. He thinks it'll come in a little bit slower than that, so less than 4%. And Hedgeye, they're in that around the 4% camp rate as well, in that range. So there's a lot of different various things. And one article here, Wall Street strategic forecasts for 2022 differ by the second most in a decade. This is from Wall Street article back on 12/9. So I just brought this article out because folks are just throwing a dart in the wall, quite frankly, from all the different strategic partners that we use, Argus included, as far as it's all over the place. So as things firm up, these people still anticipate a good solid year for 2022. Just everything will be slowing, no recession at this point. But we're going to have, it will feel like, with the volatility that we anticipate coming. So that's just a little bit of what sort of to expect into next year as well. So I sort of will end on tips of the month. We have a couple things. Number one, the gifting. Gifting, typically when folks do that, you could do $15,000 per person per year. Okay, so if it's you and your spouse, that's $30,000 for 2021, total combined. So if you have a child and you want to gift 15 from the husband, 15 from the spouse, so that's $30,000 you can gift. Non-taxable event for you and the recipient. The next year, it's going to go to $16,000. So they did raise that. So for 2022, $16,000 is the new bullseye, the new nut for gift giving. Keep that in mind. Tax credit. Remember when this started here in the summer, Nanny and I were talking about, hey, they're just trying to get you hooked on it. Well, they tried. But luckily, the Build Back Better, which wanted to extend this to make it permanent into 2022, it didn't pass. It didn't go through. So that's good. So officially, the tax credit has ended on 12/15. That's this past Wednesday, and 12/15 was the last tax credit. So remember, it was half. They front-running it at half. They wanted you to get used to that monthly deposit. So that's going to stop. So just plan accordingly for taxes. And then also a third tip of the month I want to point out. So 67 all-time highs have occurred in the S&P in 2021. 67 all-time highs thus far. It is the second most ever in the history of the stock market for the S&P. So I wanted to point that out. And 77 is the most ever in a year, and it came back in 1995. So 1995 was the most ever all-time highs. That was 77. and this is the second most, currently held at 67, closing all-time highs for the S&P. So that came from LPL, but that's some few stats I want to just throw out there, a couple tips of the month. So again, it's been an interesting year for sure. We wish you all a blessed Merry Christmas, Happy Holidays, Happy Hanukkah, Happy New Year, everybody. Be safe, healthy. We appreciate you, value you, and we'll see you in January. You take care. On behalf of Andy, Stacy, Russ, and myself, stay well. Merry Christmas.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. Investing involves substantial risk. True North Wealth Partners and Stratus Wealth do not make any guarantee or other promise as to any results that may be obtained from this. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. No reader should make any investment decision without first consulting his or her own personal financial advisor and conducting his or her own research and due diligence.